Good morning. Yesterday we have seen how we are going to use trading instrument and what are the various kinds of trading instruments and what are the risks that are involved in using those instruments, starting from investments and MTF and day trading, and after that how we are going to use futures trade where there will be more risk and more leverage. We have seen this class in the previous session, and today's session we will be talking more about capital management and risk management. When we are when we are venturing into trading, then we have to understand what is the kind of trade that we are going to take. In previous classes we have seen how we are going to analyze the market, and in this week we are seeing how which trade we can take, and depending on the trade what is the kind of capital management and risk management and what are the strategies that we are going to use in this trading journey. So in order to protect our capital, in order to reduce our risk, these are the strategies that we are going to see today. And by using these today's class, we can understand that when we get ourselves into a trade, and what are the kind of risk management things that we can do, so in order to protect our capital. Because for a trader, when he takes a when he gets into this trading journey, protecting his capital and growing his capital is of utmost importance. And when we know when we understand the market also, sometimes because of our poor capital management and risk management, we'll end up making losses. So in order to reduce our losses, we need to understand how capital management works. So first of all, so a brief introduction about capital management. What is the capital management? What capital management means, how much money we have got in our account, and depending on the depending on our skill levels, depending on our trading journey, and depending on our confidence in a trade, what is the kind of capital that we can keep into this trade? This is what we are going to understand today. So what capital management means, first of all, how much money you have got in your account, that is the whole capital that you have. And let's just say you have 1 lakh rupees of capital in your account. So if you are doing investment, then you can invest the total 1 lakh rupees into your stock, because the risk involved in investment is very low. But at the same time, when you are going towards margin trading fund or day trading, then we can't keep the whole capital, the total capital, into a single trade. Because when we are taking leverage into trades, that means that we can use smaller capital in order to do the same kind of investment. This is a equation that works. For example, you are having 1 lakh rupees and you can invest total 1 lakh rupees in your into a stock. That will give you and let's just say that will give you the whole position of purchasing a stock. But when you're going into MTF, then that means that with the 25% of capital, we are going to hold 100% of investment. That is what leverage gives us. The advantage of having a leverage is, let's just say we are taking Tata Motors stock. In a Tata Motors stock, we are having 4x leverage. That means that with 25,000 capital, and we will be able to take 1 lakh rupees of shares. That means that in a percentage wise, we are using 25% of our capital in order to have 1 lakh trade. That means 100% of our trade can be done with just 25% of capital. That means that when we are taking leverage, then we are taking advantage of the system, and with our own expertise, we will be able to produce better results. And one more advantage that we have with taking leverage is, with a very small price movements, with very small price movements, we can increase our capital, we can make good profit. That is what the whole concept of leverage and capital management comes up. So let's just have a scenario where we will be taking 100% of leverage, 100x leverage. In crypto, we have seen there are opportunities for us where we can take 100x leverage also. So in such a kind of circumstances, what are we going to do? In such a circumstances, let's just say we are taking 100% of 100x leverage. That means that our whole capital is at 1 lakh rupees, and we are going to get into a trade where our leverage is 100x. That means that what is the kind of capital that we have to bring into the trade? This is what we have to understand precisely. So when we are taking 100x leverage, then if we take a trade of 1000 rupees, then the trade of 1000 rupees will be multiplied by 100x and our whole capital of the trade will become equal to 1 lakh. That means that we are taking 100x leverage and we are bringing only 1000 rupees of our capital into the trade. By doing this, we can understand that with just 1% of our capital invested into the trade, we can hold 100% of the trade. That is how this leverage works. So when we are increasing our leverage, when we are taking more and more leverage, that means that our capital management has to be reduced. When we have 1 lakh capital, then we should only bring 1% of our trade into 100x trade. For let's just say we are taking 4x leverage, that means we can introduce 25% of our capital into the trade, or else sometimes we are investing. Let's just say we are investing, then that means that 100% of our capital can be invested into a trade. This is how trading instrument has to be worked. So for example, what happens when you are bringing 10% of your capital into a 100x trade? Such a scenarios occur. When you are taking 10% of your capital, that means you are investing 10,000 of your capital into a 100x trade. That means that your whole trade value goes up from 1 lakh rupees to 10,000 into 100x, that goes to 10 lakh rupees. So what you are doing possibly is, when your capital is at 1 lakh rupees and you are taking a trade of 10 lakh rupees, that means the risk associated with your trade is 10 times more. You are risking 10% of your capital, but the risk is too high. So in order to manage this risk, we will understand how risk management also works. But whenever in our trading journey, we always have to have an understanding of what is the kind of trade that we are taking, how much leverage we are associating with the trade, and depending on the capital that we have, how we can balance a trade, manage a trade, bring it to profit. This is a very strong, this needs to be understood. Whenever we are taking higher leverage and we are let's just say we are doing 100x trade and we are keeping 100% of the capital, that means that if the trade goes wrong, because the probability of that 100x trade going wrong is very high, the risk is very high. That means that we are keeping 1 lakh rupees into a trade where the risk is very high, and if the trade goes wrong, if the trade goes south, that means that we are going to lose the 100% of our capital. In a trader's journey, protecting his capital is of utmost importance. And whenever we are not following this structure of what is the kind of leverage that we are taking, how much capital we are introducing into the trade, this gives a strong, by having an understanding of this, then we will be able to do trades on a much regular basis. We will be not, our capital will not be lost so fast. So this is a strong space. So in capital management, what are the strategies that we are going to use? First one is position sizing. So what does position sizing mean? That just what I have explained you right now. When your capital is at 100% and you are taking a 100x leverage, that means you have to introduce only 1% of your capital into the trade. That is what is position sizing, and fixed percentage of portfolio, risking 1 to 2% of trade. So if your leverage is too high, if you are trading options, or if you are doing futures trade with higher leverage, that means that you can only risk 1 to 2% of your capital into these trades. Otherwise, you can invest the rest remaining 75% or 80% into the investments or MTFs. So diversifying your portfolio. When you have 100% of capital, that means that you have to invest 80% of it on a stock, 20% of it you have to keep it on a MTF, and remaining 10%, in the remaining 10%, you can only trade with 1% or 2% with the very high risk trades. So this is how you will manage your portfolio, this is how you will manage your capital. So by doing this, what happens is your position size will be reduced, your risk will be reduced towards the market, and also these are also risk controls that we are having, where every month, every week, every maximum drawdown limits will be setting a particular limit, that if I lose 5% of my capital into this in this month, then I'm not going to risk my whole capital. This gives you a more stable space. That means that if I am losing 5% of my capital on a options, or else on a 100x leverage trades, then that means that my maximum risk limit has reached, and I'm not going to make any trades under these circumstances. If you are wrong, then your maximum limits will be defined, and by doing that you will be not losing your capital. For example, you have 1 lakh rupees this month. You are investing 70,000 rupees in a stock. 20,000 rupees you have taken an MTF, and the remaining is 10,000 rupees. In the 10,000 rupees, you have taken a 1,000 rupees trade, and in with that 1,000 rupees trade, let's just say in a month you are losing 5,000 rupees. With high leverage, these are the risks. So you are losing 5,000 rupees, and you are closing the trade. You are booking your losses, and the monthly drawdown limit is 5,000 rupees maximum for these risky trades. And after 5,000, you are losing 5,000 rupees. You will be not trading these risky instruments that month, because your lower limit has been hit. That means you have lost 5,000 rupees. That is how we will define our risk, by doing weekly loss limits and maximum drawdown limits. So by keeping a proper limit on your losses, by limiting your losses, you will be growing your capital in a much more strong space. And what are the other aspects that we can have is, we can diversify our portfolio into many asset classes. And asset classes means, for let's just say you are investing 25% in Tata Motors. That is a it is a vehicle space, and remaining 25% you are investing in Ultratech Cement. What happens? You are investing in real estate, cement, steel. So you are diversifying your portfolio into many assets. It is not only just in a singular, sector. Automotives is a different sector. Construction, real estate is a different sector. IT industries are different sectors. IRFC, railways are a different sector. So by diversifying your portfolio into 3 or 4 different sectors, you will be limiting your risk also, because there might come a circumstances where all automotive stocks will go down, but at the same time other stocks like airplane stocks might go up, or else real steel sector might go up. So you will be limiting your risk by diversifying your portfolio into many other asset classes. This is how we will manage our capital. And so, portfolio allocations. We are having different distribution of capital across different trading strategies, asset classes, market sectors, and geographic regions. Geographic regions means, for example, you are investing crypto. It is a different geographic region. You are investing in China. That is a different geographic region. Let's just say you have some capital invested in your Indian account also. That means you are diversifying your capital into many geographic regions. If suppose India doesn't perform well, then your portfolio will not take a hit, because your portfolio has Chinese stocks also. Your portfolio has US stocks also. Your portfolio has crypto allocations also. That means that one sector will be balanced with other sectors, other geographic regions. Sometimes what happens, most of the times what happens is, when crypto goes up, afterwards Indian market will start perform, or else Indian market doesn't perform but China performs better. So by doing this diversification into different asset classes and geographic regions, you will be limiting your exposure towards risk. That is how portfolio can be managed. When your portfolio grows into multitudes, when your portfolio grows exponentially, then this is how you can manage your portfolio, limiting your risk by diversifying into different sectors, by diversifying into different geographic regions. And apart from that, there is a leverage management also. That means as we have seen, when we are investing our 1% of capital into a highly leveraged trades, that means that we are understanding the meaning of what brings leverage trades, how leverage trades are too risky. By seeing that, we will be able to manage our leverage also by overall leverage exposure, maintaining adequate cash reserves, and stress testing your portfolio. By doing this high leverage trades also, what you are doing is, you are limiting your exposure towards high leverage trades, and your reserves will be very high, because you will not be investing total 1 lakh rupees into highly leveraged options. So by doing this, what you are doing is, you are protecting your portfolio, and by protecting your portfolio, your cash reserve is is stable. When let's just say in a month you have a 5,000 loss also, you will not be so affected by the loss, because your portfolio will be performing good, and from there you can extract profits and again do the risky trades next month. By doing these kind of strategies, you will be managing your capital, and by managing your capital you will be able to trade in a much more strong space. So that is what leverage management is. And after that, we see that how we can reduce our risk also. So by managing capital, we understood that how our capital should be allocated into different diversified sectors, different diversified trading spaces, different strategies, different asset classes and trading instruments. But after that also we will be exposed to some kind of risks. So risk management also is a major part in trading. So what is the difference between capital management and risk management? Capital management and risk management are one and the same, and capital management is much more important. But when you are doing risky trades, then how do we analyze risk? How do we analyze risk, and what are the things that we can do in order to reduce the risk? Let's just say we are doing 100x leverage trades. That means that when we are using stop loss and take profit, then we are defining our risk, that I will be losing 25% of my trade in this when you are defining your risk of 25%, then with 25% my stop loss will be hit and I will be pushed out of this trade. That means you are defining your risk. When you are doing high leverage trades, you have to define your risk, and that is how risk management is done. By not defining, that means that when your capital is too high, you can bring capital into these trades also. For example, you are doing a high leverage trade and you are not keeping any stop loss. When you are not keeping any stop loss, that means that you have many asset classes, and somewhere you will be having profit, and from that profit you will be bringing capital into this risk trade. So by managing the capital, by managing what kind of trades you are doing, you can manage the risk, and that is what we have defined here. So what are the risk indicators? Risk indicators means when you are doing risky trades, we have to understand by practice and by analyzing the market, what are the risky indicators that are associated in the market. In India, as we know, volatility indicators are there. Volatility indicators are, we'll go to a chart. This is called VIX, Volatility Index. So this is of a US definition of VIX, but in India also we have VIX.India. Indian VIX. So this is a Indian VIX index. So what does this do? This is a volatility index. Volatility index. What does volatility index do is, you will this index gives us a understanding of how much volatility there might be a possibility in the market today. This is a daily chart. In a daily chart, we see that there is a very low amount of risk involved in the market, and that is why we see that VIX has been dropped. VIX has been dropped means there is very low volatility in the market. So the risk of losing a trade in this market is very low. When volatility is too high, that means that the market can move up or down depending on the VIX. When VIX is too high, let's just say VIX is at 20 or 22, that means that the possibility of the market to move up or down is too high. That means volatility is too high, that means our risk is too high. When our risk is too high, then we have to manage our trade much more faster. We have to precisely define our losses. We have to ample amount of capital has to be kept reserved for this. Cash reserves should be strong when there is high risk in the market. So this is how we will be understanding what is the kind of risk we are exposed to in a market. This is a risk indicator, and so by keeping stop loss orders, we will be limiting our risk. We will be checking our portfolio and we will be checking our trades to the risk tolerance. Volatility indicators will be following. Dynamic adjustments. Dynamic adjustment means whenever we are losing a trade, whenever let's just say there is a you have taken a high leverage trade and you are losing the trade. That means that in order to manage that trade, you have to understand dynamic adjustments must be done. What are the meanings of dynamic adjustments? Dynamic adjustments means whenever you are losing a trade, you have to remove your capital out of the trade. For let's just say you have invested $100 in a risky trade and you have already lost $50. Let's just say you are not using stop loss also. When you are not using stop losses, what you have to particularly do in the trade is you have to remove the capital. You have to remove the capital. You have traded $100 trade. You have took a $100 trade. You are losing $50. Then $50 has to be you have to book a loss of $50 and you have to reduce your capital in the trade if you are going in loss. Let's just say that trade again goes much more deeper. You are losing more 100% out of the trade. Then what you do? Then you take out more 50% of the remaining trade. By doing this, what you are doing is you are dynamically adjusting your trade depending on the risk that you are involved. For let's just say you are going in a positive, you are making a profit of $100 out of $100. Then if you have confidence on the trade, if you think that market will go much higher, then what you possibly have to do is you have to invest more. You have to add to your position. I hope you are understanding. For let's just say you have a capital of 1 lakh rupees and you are trading high options or high leverage trade with 10,000 rupees. And in a 10,000 rupees, you are making a profit of 5,000 rupees. Then what most probably we will do is we will be ending the trade, we will be getting out of the trade and we will be booking our profit. But when we are in a positive streak, when we are making profit, what dynamic adjustment means is when we are moving in a positive side, when we are having profit, then we should not book our profit, but rather we have to invest more. We have to bring more capital into the positive trade. So this there is a common phrase which is said that let your positives run, but you have to cut down your losses. So this means that whenever you are going wrong, you have to reduce your position size. Whenever you are making a profit, you have to add to that position size. This is what dynamic adjustment means. So what dynamic adjustment is when you are going right, when you are making profit, then you have to add more position. When you are going wrong, then you have to reduce your position. By doing this, you will be limiting your risk. Whenever you are in losses, you will be making small losses. But whenever you are in profit, you will be making more profit. So that is how dynamic adjustment works. I give this a strong read. In my book, I have given clear understanding of how risk management and capital management does, and later on we can also see that how trading psychology will also work. Most of the times it's not just about analyzing the market, understanding the trades and taking those trades, but creating a positive trading psychology within ourselves in order to be in a positive trade is also very much important. Most of the times what happens is our analysis will be spot on, but the confidence of holding the trade, the confidence of taking a trade will be damaged because we don't trust our analysis totally. This happens to a lot of traders because of the volatility in the market, because they are not ready to see any losses in the trade. What we end up doing is we'll be always booking our losses and will not always book our profits. Most probably what will happen is whenever we see a red, whenever we see a loss, we'll be exiting the market, but we do not do the same thing when we are in a profit. Most of the times the best thing that can happen is when you are in losses, reduce your position size. When you are in profits, increase your position size. So by doing this, you will be training your mind also, your trading psychology also will be apt, because just analyzing the market is not good enough. Being in a trade, taking a trade and bringing the trade to a positive space is also more important, because that is what a trader is defined of. It is not just of analytical mind is very easy to understand the market, but being a trader, keeping your own capital, risking your capital and managing the trade and bringing to the profit is also a trader's job, and trading psychology will help us in that. You can read this one, you can understand what are the examples we have given, key to success and training and experiencing these trades, and being in a trade, taking high leverage trades and risk managing these trades will also give you a lot of experience. So this is how capital management, risk management and trading psychology, these things play an important role in building a trader, in building a proper trading space in your mind and in your trades. This is how it is done. Thank you.